We're excited that you've been able to join us today, and welcome to AlphaCode for those that have never been here. This is AlphaCode, a clubhouse for next generation financial services entrepreneurs. Now, the topic for today is around the budget speech that all of us, I'm sure, have read or listened to live as it happened, but the impact of that on small businesses today. And we've got Annabel from Investec that's just basically going to give us some nuggets or some tips around what it means and how you can translate that into your business today. Thank you very much.
Okay, great. I guess I'll just start. The point I think I really want to make is that I do need to leave at 20 past because I have got a TV interview, so I'm going to have to walk out just before then. But just to give you a synopsis of the budget, I think we obviously have had it out for a while. We've had time to read it, we've had time to digest it. And there are two really key points for us from a macroeconomic basis before we boil it down into what it means on us at a lower level in the economy. I think certainly if you have a look at the budget, if you have a look at what came out, there was a good trend of fiscal consolidation. So for those of you who are not too sure what that means, you're probably missing the whole credit rating agency debate. But I think basically, as we know, South Africa is online for potential downgrade to its credit ratings. The worry there, obviously, besides the borrowing costs going up, the negative investor sentiment, it also impacts our corporates quite materially as well, and of course the currency. These are some of the issues. Certainly under fiscal consolidation, we saw because the budget is a plan. It's not an actuality, it's something that plans government expenditure going forward. Certainly under the budget, we saw the expenditure being reeled back in, particularly current expenditure. And if you look at current expenditure, certainly expending on civil servant salaries and wages, there's two forms of current expenditure, whether it's on social welfare or on civil servant remuneration, as we're talking about. And basically, we don't want to pull back on the social welfare. Obviously, it's really important for us as an economy and as an emerging market, as a developing nation, to obviously be able to uplift the people who live in our society. But on the other hand, when we see civil servant salary and wage increases at 10% plus and inflation is running at 3 to 6%, that is quite substantially higher than we can afford. And I think affordability is probably the key theme for the budget. The credit rating agencies are looking at the affordability of government expenditure, of its debt, in an economy that is seeing a substantial slowdown from an economic growth perspective. And really, if you have an economy that was running at above 3% growth in 2011, and in the last 2 quarters that we have seen, is actually seeing economic growth of 0.2%, you can see you've got a bit of a problem. And that slowdown's been persistent over these years. It's been a trend. So it's not just a once-off phenomena. I think the credit rating agencies are very concerned. They're not too sure how exactly will we fund our expenditure plans if our economic growth continues to dwindle, if tax revenues are negatively impacted, therefore. And obviously, as a consequence of that, is our perceived credit worthiness at the right rating, or should they dip it lower? So these are just some of the facts which we're experiencing at the moment in South Africa. I think also as well, if we have a look at Moody's, who's here to review us this week, they obviously are next. They're obviously having quite a good look at our economic growth story as well. So the really other big key feature. And if we look at the budget, I think the budget was fairly credit neutral in terms of its plans, but the agencies are more concerned how will we affect them, how will we materialize it, how will it actually come to bear in an environment where we have such weak economic growth. And of course, that's the second point they've come to assess us on economic growth itself, and how are we going to lift ourselves to a faster trajectory. So I think that's really the budget in a snapshot. And if we break it down a little bit more, we are at quite high debt levels. So debt as a percentage of GDP is running close to was actually tipping over 40%. It's a problem. The IMF wants us below 40%. They say really it's a danger zone for emerging markets. And as we know, emerging markets are volatile. We're a small open economy. We're heavily influenced by what happens on the global stage. And globally, we obviously are seeing slower economic growth as well. There's a global commodity slump, downward revisions to economic growth outlook. And I think certainly at the start of this year, we had one of the most volatile market starts. We remember saw the rand go close to 17, but globally we saw a huge sell-off, and that was both in the equity markets as well as your commodities and your debt. In fact, this is probably one of the worst starts of the year we've seen since 2009. And we recall in that period we had the global financial crisis. So obviously substantial currency weakness then. So I think these are some of the factors we're looking at, the environment, as it were, that South Africa is operating in. In terms of the budget itself, it certainly did look at many different factors, but I think by now you probably realize there's not that much money to go around in terms of the budget, in terms of expenditure. And there's a lot of parties or a lot of groups, obviously looking for more funding. Maybe another way of looking at it is government departments. So I think from that perspective, we are constrained financially. We're not the only economy in the world that's seeing slower growth. As I've said, it's a commodity factor. Our commodity exporters globally are seeing a significant slowdown. And indeed, virtually all the commodity countries are actually cutting interest rates in order to support their economic growth. So if you look at commodity currencies or the exchange rates of countries that export commodities, you can see those have all depreciated. So it's not just the rand. There's been a substantial amount of depreciation across all of them. The rand certainly had been more pronounced in some points, and that's because we're also an emerging market country. So not just a commodity country or currency, also an emerging market currency. And there we are obviously impacted by what happens globally, whether it's normalization of monetary policy or the United States looking to hike its interest rates back to neutral levels. And of course that does impact us, as well as the global emerging market sell-off that we've seen. That's impacted the debt of these countries. So these types of situations cause our currency to weaken as well. So a large amount of factors that all boil down, I think, to the situation probably being not as good as it was when we were running a fiscal surplus. And for the budget, that's really the point. If you have a look at the 2008, 2007 period, even 2005, remember we had good economic growth. A lot of it was credit fueled, but we also had a budget that was in surplus. And now our budget is in a deficit. The fiscal deficit obviously is the key point to the budget besides the debt ratios, and that fiscal deficit is unfortunately too high. On a fiscal consolidation basis, they need it below 3% of GDP. We're above that. Certainly over the budget or the planned period that we're looking at under the government, the budget was presented to government recently. Out to 2018, we do see it drop down below 3%, so dropping down to about 2.5%. But really, it's slow, and there's something called fiscal slippage as well, essentially when you don't meet your targets. So we've had a target of below 3% for our fiscal deficit for quite a long period now, and every year we just keep on revising these figures forwards. We don't quite meet our targets. The credit rating agencies, as we know, have had enough. We've had quite a few credit rating downgrades since then, and as I said, we're at risk of another one. Currently, we're sitting at the last rung of investment grade, the BBB category, for hard currency debt, and we're sitting slightly above that on a local currency. Most of our issuance is in the rand or local currency, but the risk obviously is that investors don't want to wait until your debt instrument falls into the sub-investment grade category. So there's been sell-off, and of course mandated funds, many of them can't actually hold sub-investment grade debt. Okay, so I think I've given you a snapshot. We can go into some areas you're more interested in if anyone wants to ask any questions now.
Thanks. There was a very vague statement in the budget around SME support and sort of cutting of red tape and general, I think the term was support. Can you venture any guesses as to how that would practically play out?
I think that's really the point. I think it is a bit vague, and certainly I think the intention from National Treasury is for that to be in place, for there to be a red tape cut and the support given, but I think it's up to the small business department themselves to effect it. So I think that's really the point of the budget. The budget is just one department that controls finances. It gives a view of how spending is going to happen on an overall level. But in terms of the detail and how it's going to work, and more particularly how this money is going to be put to good use or not, is actually the requirement of the individual department. So I think, if you follow the small business department and, see what they have to say about it, that should certainly give you an indication. But it's a bit more than that, more than the small business department's own particular budget as well. It's also in terms of their policies and how they're going to affect it. So, yeah, like you, it hasn't given me greater clarity. Any other questions? Yes.
Just giving you a sense of your confidence of the Treasury and the government as a whole to achieve their cost-cutting measures. There was very little detail in the budget speech on on how those cost-cutting measures were achieved. I think if they're relying particularly on what they refer to as a churn of staff and hiring freeze in certain departments, I mean, I'm not quite sure if they'll achieve that detail.
Okay, so a great question. I think it comes back to current expenditure. You know, we want to cut current expenditure and we don't want to cut expenditure that stimulates economic growth or growth on fixed investment. In terms of what they're going to do, look, certainly there is always churn, you know, and I think it's quite interesting they're going to put a payroll freeze that you actually just don't pay people. That'll put a stop to it. But I think also just in terms of giving people salary and wage increases. You know, last year civil servants got 10.1%. If you give them 4.5%, which is supposed to be what the midpoint of the inflation target range is, and therefore what everything is supposed to tend towards, otherwise what's the point of inflation targeting in South Africa, then that's the increase they should be getting. And I think you saw the parliamentary increase was 4.4%. So if they roll that out or pull it out through the rest of the civil servants. Interesting to see how they do it. But if they do, then obviously that will be a cost-cutting measure as well. And I think one of the reasons why it's so difficult, why I find it difficult, is that you're having your electricity and water tariffs increasing by double digits. People have got to live, they've got to pay these, and yet, you know, you're trying to cut back in other areas. So quite frankly, I think we need a lot more efficiency in the economy. It's probably a broader answer to your question than you were anticipating. But certainly, you know, if we can manage to do things more efficiently and not have to spend so very much on everything we do. I mean, look at Medupi, over budget, over period, still not producing. If we can do things better, then it's not going to cost that much. But the bottom line is people need to live. And if your electricity bill is rising by 10, 20%, you know, your water, etc., it comes through in terms of wage demands. And I think that's the point. Your civil servants, the bulk of them number-wise, are not such high-income earners. You know, they certainly push for higher wage as well. It's difficult, it's political, it's an election year, but, you know, this is the path that we need to tread if we want to pull back on fiscal consolidation. And maybe the question also is, why do we have so many civil servants and so many departments and parliamentarians when other countries actually manage to do with less in much bigger economies?
Quick last one. What's worse, the expectation of a junk bond status or actual junk bond status?
You know, I think at the moment we're getting a lot of this expectation you're mentioning. So we're seeing it coming through in the impact on our yields, for example, of our bonds or our CDS spreads. In terms of the actual impact of it itself, well, obviously you'd anticipate rand weakness. And I think, you know, something to bear in mind, you know, certainly if you're an investor, you'd want to sell out before, but if you're a mandated fund, you might wait until it happened. Maybe you can only sell out part, you still keep part of the bond. So it's quite vague. There's a lot of different factors. You don't have to sell out immediately. Some of them can wait 6 months. The bottom line is, probably when it actually happens, it's worse when you go into sub-investment grade, because the credit rating agencies have calculated it takes about 7 years to come back. You know, so it's not like you fall out of it and then you hop back in. You know, it's a very, very difficult thing to achieve. And it's a very easy thing to throw away.
I was listening to 702 yesterday, and one person, you know, these financial people, called in and actually was saying that junk status is actually not the end of the world. And my question then is, how much impact, especially to the SME market, does that kind of a status have?
Great, okay. So look, junk status is not the end of the world from the point of view that many countries have it. You know, we're not the only, not every country has investment grade rating. Makes your life a lot easier. Why junk status makes your life more difficult is because the big debt that you've got already, and as I said, we've already got a bit too much, becomes a lot more difficult to service. In other words, the cost. So if you have a look at your budget itself, the fastest growing item is the debt servicing costs. They're just too high, they're growing too fast, and they're basically a waste of money, you know. But obviously, all countries have debt, and we were doing quite well until we suddenly ballooned since 2009 until 2014. From a small business perspective, well, if we get major currency depreciation, depends on which side you're sitting. Are you an importer or an exporter? But also in terms of South Africa itself, you know, currency weakness does cause inflation to go up. It causes the operating cost of businesses, therefore, to go up. And in a higher operating cost of environment, you can answer the question yourself. Yeah. Yes. You two can
So I
fight
got
it
the
out.
mic- Got the mic right. I'm Conrad from #South Africa. I've got a bit of a problem solution that I'm looking for. Based on the way the markets are going, a lot of technology companies are looking to get work in international countries. Would you, while we're doing business in those countries, would you suggest that we look at opening up an accounts outside of South Africa, or use our South African-based account, and how can we stay tax compliant in this whole process?
I don't think that's really a question for an economist, do you? I think it really depends what you're doing. You know, every corporate's different, you know, in terms of their requirements. If you're operating outside of South Africa, how much are you operating outside of? A little bit, a lot? You know, what country are you operating in? Are you borrowing there? You know, it's going to depend on a lot of factors. I mean, if you can be a bit more specific, maybe.
Sure. So the work would be purely technology, so it'll be cloud-based solutions, finance or whatever the industries may be online. Transactions will be basically not products but services rendered, and services done by human capital basically here in South Africa.
Look, I mean, I can't advise you because that's not my job, but certainly from an analysis point of view, you need to look at the different costs and benefits of doing such a exercise. And if you're in a hard currency country, obviously your borrowing costs will be a lot lower. And also it depends as well where your bulk of your operations are going to be and ultimately your tax base.
Okay.
Right now, Annabel, I was just going to ask, I see Mike Schuster's just come out and said that if we become sub-investment grade, they expect us to experience interest rate hikes of between 2 and 5%. And then I've seen some other articles about the currency. Some people are saying that the currency would go out as far as 20 rand to the dollar in the short term. Can you just give us your opinion in terms of? I know that it's, but yeah, but we won't hold you to it.
I can tell you that whoever's right is just pure luck. No one's going to be able to give you the exact figure. But, you know, the expectation, as you said, is that it's in that direction, a weaker currency, higher interest rates, etc. Look, I think a lot of that is being front-loaded already into the markets, the anticipation that we're probably going to have a Moody's downgrade. I think the anticipation that we're going to have a hard currency downgrade. Not too sure if a local currency downgrade's factored in. So pure junk status. All our bonds, everything is, you know, in a junk status. That probably not. So in that tough environment, sure, it's easy to go to 20 rand. I mean, we hit 17 in January. You know, it's only 3 rand away. And, I mean, the bottom line is there's all sorts of shenanigans going on politically, you know, and with our finance ministers and all sorts of situation. And that's seen negatively by foreign investors for one reason. They want stability. They want certainty. They want to know that Pravin Gordon's always going to be there. He's always going to do what he says, and they're not going to deal with someone new. And it's boring and it's mundane, but such is business, as you know. You know, there are too many other things to worry about. So from the perspective of your investors into the markets, sure, I think South Africa is very much in the focus at the moment globally. So we obviously are having a lot of heat on us. But the bottom line is that I think they're reassessing, you know, which direction is our government going in? Are we going to be populist? Are we going to pursue a different type of environment? Are we going to become like some other African countries? Or are we still going to stick to our institutional strength, our institutional pillars? Are we still going to have a well-regarded financial services market? Are we going to have, you know, investment grade rating? All of this is a little bit up for debate at the moment. I think this is where you see this uncertainty coming in and the risks to the currencies. Look, I mean, you know, who knows? In 2 years' time, I'm not too sure why, but we could be in a commodity super cycle and the world could have turned and things could look better, but it just seems unlikely at the moment. It seems more likely we go for the weaker route. Yeah.
I have a question. I know you got to go.
Yes.
Was there any good news?
In the budget?
Yes.
Look, I think the good news came from the consumer perspective where we didn't have major tax increases. And from that point of view, I think it shows the maturity and the experience, the ability, the soundness of our finance minister that he didn't decide to go for major tax increases and cause a situation where the economy is already weak to weaken even substantially further. And, you know, I was at SARS last week in the economic policy debate, and we're trying to work out how on earth you increase taxes in an environment where your interest rates are going up. it's far more valuable to increase taxes because at least you're getting the money back. Where's the interest rate increase going? So I think from that perspective, the economy is weak. We didn't get tax increases as such majorly, but there were still some from fiscal drag, from capital gains tax. And I think going forwards, we probably are going to have tax increases, and it's going to be very fascinating. What do we do with fiscal policy tightening and monetary policy tightening simultaneously? Your economy is already risking recession. You just drop down into it possibly. So I think that was good news, the fact that they also did the fiscal consolidation as well. But people have realized it's not a one budget solution, and it's not a one-man solution. The finance department can only do so much. And going forward is going to rest on the shoulders of all the other departments to get themselves into gear, particularly our state-owned entities. So I think that was the message from the budget. Other questions?
Okay. I have a question
Yes.
here just to understand some other things when it comes to Africa. Because
Yes.
I think when we look at South Africa, it was like one of the key countries in Africa to build up Africa to be united and also to stimulate our economy. But since now we are going to be maybe downgraded to be a junk state, what can someone do if is in the small business? Let's take for an example, right now, Nigeria probably is the one of the biggest economy in Africa. Should we consider to invest maybe into West Africa or what?
Are you saying that you have an investment strategy into Africa and you...
Not yet, just trying
Okay.
to understand if, let's say, you have to look at it to say, okay, fine, the economy now is not doing well here in South Africa.
Yeah. So where else do you go?
Yes.
Yeah. Look, I think that move was already made by many businesses a few years ago, and certainly from our retail sector we saw it. It was one of the reasons why we saw a retail boom. Moving into Africa and obviously selling. I think many other countries companies followed suit as well. The trend now seems to be more into developed countries, which is quite interesting, and maybe it's because we've had this pullback in economic growth in your African countries, and you saw it with the commodity slump. Many countries obviously doing very poorly, regulatory issues, other issues as well. You've seen what's happened to MTM with Nigeria. So I think from that perspective, these trends come and go, but it seems like the shift is now going into more into developed economies. The bottom line really for you is where's the growth coming from an economy perspective, from a macroeconomic perspective, and also from a sectoral perspective as well. So ultimately, as an investor, it's going to be up to you, seeking out the good growth sectors and doing the analysis. It's going to be more macroeconomic in nature, I think, when you talk small businesses. Yes.
I was also listening to a radio station yesterday, and one of the finance people
Yes.
mentioned that companies abroad, especially mutual funds and big companies, they are led by policy only.
Okay.
And policy says you can only invest in countries with a status at that level. So you are mandated by policy to exit should they get to that status.
Yeah.
Now my question is, how exposed are we? How many of such companies do we have here that should we be downgraded, they will all uproot themselves?
You see, I don't know the answer to that question because I don't think anyone's actually done the study then can tell us. But I think certainly from a mandated fund point of view, it's quite large. If you look at a debt perspective, foreigners hold about 40%, 30 to 40% of our government bonds. Okay, so that already tells you there's a big effect, if there was a pullout. In terms of a corporate perspective, well, I think, again, I'm not a microeconomist, I'm a macroeconomist, but certainly I'd say the risk is there. I'd say that a lot of experienced, mature corporates are already factoring what are they going to do if we get a credit rating downgrade. I think many people think the writing's on the wall, and I think you already see some corporates repositioning themselves, pulling out, retrenching. And I suppose the more likely it becomes that we get that, the more that's going to happen. So really I'm not a macroeconomist, but if someone who would be a macroeconomist would look at that type of area and be able to calculate that for you. Yeah. Any other questions? Yes.
Just a quick one.
Yes.
We are not unique in the situation. I mean, Brazil, okay,
Yes.
but dramatic in
align
their-
ourselves to them, but anyway,
No,
yes.
it's a bit dramatic. I mean,
Yes.
3.9% down. Like, GDP, that's pretty
Yes.
dramatic.
Mm.
I don't know what's happening to Turkey. Russia has taken a bit of a beating in the last few years.
And they're commodity exporters.
Commodity exporters. What have we learned in terms of how junk status impacts them? How do you, I don't know what their portfolio in terms of domestic holdings and offshore holdings of their bond portfolios, but what can we pick up in terms of just lead indicators from people who are just experiencing this a little quicker than we have?
I think it's really hard because their situation's different to ours, and therefore we can't necessarily use them as a benchmark. And why I say that is that Brazil and Russia have been falling apart more severely and for a lot longer than we have. So I'm not saying that we're falling apart, but I'm just saying that, if you were to do the comparison. And the point that I'm trying to make is that basically it's a situation where they've got huge political problems in Brazil, inflation problems, major growth problems. It's so much worse than ours that there's not actually a correlation. And that's the problem. If you look at Russia as well, they've also had major issues as well. And South Africa's situation is a bit different. Maybe politically we'll get there. Let's hope not. But the point really is that you've seen major slides in their currency, and their currencies have performed substantially worse than ours if you were to do an analysis. And the risk is that we see something similar. The point is that global investors are not stupid. They do factor it in, they do build a hedge, they do build a risk. But ultimately, when you go, you go. And what's different for us is that we have got a very mature, sophisticated financial services sector. Those countries you mentioned don't have that. And if we manage to continue to operate with it, that is good, but it's going to be damaged by a sub-investment credit rating. And those countries who don't have it would have had less damage in that sphere. So look at your economy, look at what's the biggest growth drivers. And I think that's the real risk for us. Brazil's very commodity heavy. We're quite commodity light, even though it does obviously impact us. So the bottom line is, yes, they've had big pressures, and I think we will also see pressure on our currency. We'll also see higher inflation. I don't think we'd see political change. I'm not sure if everyone in our government is worried about a credit rating downgrade. They might say they are, but I don't know if they are. Otherwise, why would we be trying to potentially arrest our finance minister on the eve of a credit rating review? It doesn't make much sense. But I think, the risks are there, and what you could draw from the comparison is that things got a lot worse for them, and it could for us as well.
Can I ask another question, please?
And then I'm going to go.
On the backdrop of that,
Yes.
if you think about it, Standard & Poor's, Fitch, Moody, all of them, they're in the same street in America.
Yes.
Isn't this not maybe targeting those who have started BRICS? Is this not maybe just an IMF versus BRICS thing? Because if you could check it, China's in trouble, South Africa, Brazil, Russia. Then they leave the Indians alone for a while until they too are not happy with them as well. Isn't this maybe just a smokescreen, this whole downgrading thing to fight a different war?
That wouldn't be my point of view, but I think that you obviously have got a situation where the points that you make might make it seem like that. But I think what it really comes down to is a hard fact. Either you're more likely or you're less likely to repay your debt. And for these countries that you mentioned, because of the commodity slump and, commodity exporting countries you've mentioned, they are perceived to be less likely to be able to repay their debt because the economic growth is falling. So it's not a black, white, hard, fast issue, where you're either there or you're there. You know what I'm trying to say? It's a situation where basically you have a gentle decline. So you're not saying we're getting a credit rating downgrade, so therefore we can't repay our debt. That's what I'm trying to say. Okay, they're just saying that you've got different tiers on your ladder. And either you're going up the ladder, so you're becoming more likely, or you're going down the ladder and you're becoming less likely. So they're not saying we're not going to repay our debt. They're just saying because our economic growth's been falling, like Brazil's growth's been collapsing, like Russia, like New Zealand, like Australia, like all these countries, because their growth rates are collapsing, it means you become less likely to repay your debts. I think that's maybe one point to bear in mind. You know what I'm trying to say? That it's a proper metric, and they've got proper metrics that they use to compare it. They calculate all the ratios for all the different countries, and they compare them. The debt ratio is a percent of GDP, the fiscal deficit is a percent of GDP. So yes, I think it's a natural human reaction to feel like you're being targeted. I think that is quite natural. But I think you've got to understand that you were not alone, and that if you pursue very populist policies that obviously spend more than you can afford, and this is what the credit rating agencies are saying, then this is their reaction. I don't think it's an indictment because they've taken a dislike to South Africa or a dislike to Russia. I think it's, if you have a look at their models, you can see it's just all numerical, and you've got to I think, realize as a country, South Africa has to realize that when your growth rate falls like we have, there is a consequence. People think there's no consequence. People think that economic growth collapsing is fine and we'll just carry on doing business. But you do carry on doing business, but people who invest in your country go, well, maybe not so much South Africa, maybe somewhere else, because their economic growth rate's deteriorating, it's falling down. And if your growth rate falls down, then as a percentage of it, your debt and your deficit ratios rise. So we're on the cusp of seeing the economy fall down, of GDP growth contracting, a recession. And that's what because it's forward-looking, the credit rating. They're saying that we're concerned that the growth slows down even further, and as a consequence, your ratios will rise. And in our model, this tells us this. So I think in South Africa, actually have to start taking some responsibility. And that is that our economic growth rate is falling for a big number of reasons. We need to actually have a proper look at that and say, are we going to turn this around and do things differently? Or are we just going to carry on, being happy with a collapsing growth rate and the consequences that come with it? And if you look at the Reserve Bank, they themselves have calculated every 1% increase in interest rates cuts off 0.5% of economic growth. So, where's the value in that? So the bottom line, I think, for us in South Africa is we actually need to focus on what policies stimulate economic growth, or in other words, because of the direct correlation, what policies stimulate business confidence. Faster business confidence, you can all plot it yourselves, equals faster economic growth. There's a direct correlation between the two lines. What can we do in South Africa to make businesses feel better? Probably not expropriate their property, probably not threaten property rights. There's a whole gamut of issues. I've done quite a lot of writing on it. But I do think that the bottom line is our economic growth is collapsing, and we need to, while our debt's going up, and that's what happens. If your debt climbs massively, whatever country you are, if your deficit ratio is not below 3%, if your economic growth is substantially weaker, you're at risk of a credit rating downgrade. And unfortunately, that's just the way the world works. But I take your point, but this is unfortunately what happens. And I have to go. So don't feel it's the end. If you want to email me, you're very welcome to email me. And you can also receive my economic research, but I'm sorry, I do have to go. Thanks.
Thank you so much, Annabel. Thank you very much. All the best with your interview. So we'll have Annabel's details available for you if you'd like to email her and continue the discussion and probably get a hold of some of the papers that she has written. But thank you so much for coming. That is the end of this particular talk. Please do mingle a little bit and get to know who's sitting close to you and who's in the room. Thank you very much.